Most people are terrified of debt. They've been told their entire lives that all debt is bad, that you should pay off everything as fast as possible and never borrow a penny more than you absolutely need. And on the surface, that sounds like good advice. But here's the thing. The wealthiest people on the planet don't avoid debt. They use it strategically, deliberately, and ruthlessly. While the average person is working overtime to pay off their mortgage early, billionaires are taking on hundreds of millions in new loans. And they're getting richer because of it. The difference isn't luck or privilege. It's understanding the fundamental difference between debt that destroys wealth and debt that creates it. In the next 10 minutes, I'm going to show you exactly how the rich use debt as a wealth-building tool, and how you can start applying the same principles today. Let's start with the kind of debt that keeps people poor. Bad debt is any borrowed money used to purchase things that lose value over time while charging you high interest rates. Credit card debt is the worst offender. The average American carries over $6,000 in credit card debt at an interest rate between 20 and 28%. At 24% interest, if you only make minimum payments on a $5,000 balance, you'll end up paying over $12,000 total. You'll pay more in interest than the original purchase was worth. Car loans are another trap. A brand new $40,000 car loses roughly 20% of its value the moment you drive it off the lot. After 5 years, it's worth maybe $18,000, but you've paid $46,000 including interest. You financed a depreciating asset. That's the definition of bad debt. Consumer loans for furniture, electronics, vacations, these all fall into the same category. You're borrowing money at high rates to buy things that will be worth zero within a few years. Every dollar of bad debt is actively working against your wealth. Now here's where it gets interesting. Good debt is borrowed money used to acquire assets that appreciate in value or generate income that exceeds the cost of borrowing. A real estate loan at 4% interest on a property that appreciates at 5% and generates 8% rental yield, that's good debt. The asset is growing faster than the loan costs you. A business loan at 7% used to buy equipment that increases your revenue by 30%, that's good debt. The return on the borrowed capital far exceeds the cost. Even education can be good debt, with a major caveat. A loan for a degree that increases your earning potential by $50,000 a year is a smart use of debt. But a $150,000 loan for a degree with limited job prospects? That's bad debt disguised as an investment. The key distinction is simple. Good debt puts money in your pocket. Bad debt takes money out. Good debt finances assets. Bad debt finances liabilities. The wealthy understand this difference at a fundamental level, and it changes every financial decision they make. The concept behind good debt has a name. It's called leverage, and it is the single most powerful wealth-building tool that separates the rich from everyone else. Here's how leverage works in its simplest form. If you can borrow money at 4% and invest it into something that returns 10%, you're making 6% on money that isn't even yours. That spread between borrowing cost and investment return is pure profit created from thin air. The wealthy call this using other people's money, or OPM, and it is the foundation of virtually every large fortune ever built. Consider this. You have $100,000. You could invest it directly and earn 10%, giving you $10,000 in returns. Or you could use that $100,000 as a down payment, borrow $400,000 more, and now you control $500,000 of assets. At 10% return, that's $50,000 in profit, minus roughly $16,000 in interest on the borrowed money. Your net return is $34,000. You turned 10% into a 34% return on your actual cash invested. Same market, same economy, dramatically different results. That's leverage. Real estate is the classic example of good debt in action. Let me walk you through a real scenario. You buy a $250,000 rental property with $50,000 down and a $200,000 mortgage at 5% interest. Your monthly mortgage payment is about $1,073. You rent it for $1,800 per month. After expenses, you are cash flowing roughly $300 a month. But this is just the beginning. Your tenant is paying down your mortgage for you, and the property is appreciating. At a conservative 3% annual appreciation, after 10 years your property is worth $336,000 with only $160,000 remaining on the loan. Your equity has grown to $176,000. That is a 252% return on your original $50,000, all made possible by using good debt. Smart business owners use strategic debt the same way real estate investors do. They borrow to scale. A restaurant owner borrows $300,000 to open a second location. If that location generates $500,000 in annual revenue with a 20% profit margin, that's $100,000 per year in profit. The loan pays for itself in 3 years, and every year after that is pure upside. An e-commerce entrepreneur borrows $50,000 to buy inventory in bulk. Buying in bulk cuts their per unit cost by 35%, increasing their profit margin from 15 to 28% on every sale. The increased margin covers the loan cost in months. A tech startup takes on $200,000 in business credit to hire 2 senior developers. Those developers build a product feature that increases monthly recurring revenue by $40,000. The debt generated a return that was over 200% annualized. In each case, the business owner isn't borrowing to survive. They're borrowing to multiply. They've identified an opportunity where the return clearly exceeds the cost of capital. That's the mindset shift that separates struggling businesses from empires. Using debt as a wealth tool requires discipline and strict rules. Break these rules and good debt turns into a nightmare. Rule 1. Never borrow without a clear return on investment. If you can't calculate exactly how the borrowed money will generate returns exceeding the cost, don't borrow. Rule 2. Keep your total monthly debt payments below 36% of your gross income. Beyond this threshold, one unexpected expense can trigger a domino effect. Rule 3. Always have 6 months of expenses saved before leveraging. Leverage amplifies everything, including bad luck. Without a cushion, a single setback forces you to sell assets at the worst possible time. Rule 4. Only borrow when there's at least a 5% spread between your borrowing cost and expected return. Anything thinner is too risky. Rule 5. Use fixed rates whenever possible. A 4% fixed rate loan stays at 4% for 30 years. That predictability is essential when managing leveraged investments. I need to be honest with you about the risks, because good debt can absolutely turn bad if you're not careful. Over-leveraging is the #1 killer. When you borrow too much relative to your assets, even a small market downturn can wipe you out. In 2008, millions of people had leveraged real estate portfolios. When property values dropped 30 to 40%, they owed more than their properties were worth. Foreclosures destroyed wealth that took decades to build. Variable interest rates are another trap. You borrow at 3% thinking it's a great deal, but 2 years later rates jump to 7%. Suddenly your cash flow positive rental property is bleeding money every month. Market timing is dangerous with leverage. If you buy at the peak of a market cycle using borrowed money, you might wait 10 years just to break, even while making interest payments the entire time. And leverage amplifies losses just as much as it amplifies gains. A 20% decline on a property you bought with 20% down doesn't mean you lost 20%. It means you've lost 100% of your investment. Your entire down payment is gone. Debt is a powerful tool, but like any powerful tool, it demands respect. The difference between the rich and everyone else isn't that the rich avoid debt. It's that they understand debt. They know the difference between borrowing to consume and borrowing to build. They use other people's money to acquire assets that generate returns exceeding the cost of borrowing. And they follow strict rules to manage the risk. You don't need to be wealthy to start thinking this way. You just need to be strategic. If this video changed the way you think about money and debt, hit the subscribe button and turn on notifications. Every video on this channel is designed to give you the financial knowledge that schools never taught you. Drop a comment and tell me, what's one way you plan to use good debt to build wealth? I'll see you in the next one.